Gold prices are rising sharply, surprising many investors and consumers alike. Jewelry is becoming expensive, investment demand is increasing, and headlines keep talking about new highs. But why exactly is gold becoming more expensive? Is it inflation, global tension, central banks, or something else? In this video, we will clearly explain the real reasons behind the rise in gold prices, using accurate economic logic and verified market behavior. Gold has always been considered a safe haven asset. Whenever investors feel uncertain about the global economy, they move their money away from risky assets like stocks and into safer options, and gold is one of the top choices. Currently, global markets are facing geopolitical tensions, trade and policy uncertainty, and volatility in equity and bond markets. During such periods, gold demand increases because it is not tied to any single government, company, or currency. This rise in demand naturally pushes prices higher. One of the most important drivers of gold prices is interest rates. Gold does not pay interest, so when interest rates are high, investors prefer assets like bonds or fixed deposits. But when interest rates are low or expected to fall, gold becomes more attractive. Globally, central banks are slowing down rate hikes and signaling possible rate cuts or accommodative policies. Lower interest rates reduce the opportunity cost of holding gold, which increases investment demand and supports higher prices. Another major reason for rising gold prices is inflation concern. Even when inflation is not extremely high, fear of future inflation plays a strong role. Gold is widely seen as a hedge against inflation, currency devaluation, and loss of purchasing power. When people feel that cash is losing value over time, they move towards gold to preserve wealth. This behavior is especially strong in developing economies and during global uncertainty. Gold is priced globally in US dollars. When the dollar weakens, gold becomes cheaper for buyers using other currencies. International demand for gold increases. At the same time, countries like India experience higher local gold prices because gold is imported and paid for in dollars. This currency effect directly contributes to rising domestic gold prices. In recent years, central banks around the world have been net buyers of gold. Why? To diversify foreign exchange reserves, to reduce dependence on the US dollar, and to strengthen financial stability. Central bank buying is important because it is long-term and large-scale, creating steady demand that supports higher prices over time. Gold supply grows very slowly. Mining output increases only marginally each year. New gold discoveries are rare and expensive. Recycling supply depends on price and consumer behavior. When demand rises faster than supply, prices move up. Gold markets are currently experiencing exactly this imbalance. Finally, market psychology also plays a role. When prices rise, media attention increases, more investors enter due to fear of missing out, and short-term traders add momentum. This does not create the trend, but it accelerates it, especially in the short term. To summarize, gold prices are rising due to a combination of factors, not just one reason: global uncertainty and safe haven demand, lower interest rate expectations, inflation and currency protection, weakness in the US dollar, strong central bank buying, and limited supply growth. Gold is reacting exactly the way it has historically reacted during uncertain economic periods. Understanding these factors helps investors and consumers make informed decisions, rather than reacting to headlines alone. Subscribe Global Snap and stay connected for more informative videos.